everyone. I'm Lana Zach, and it's just about 2 p.m. here on the East Coast, and we are just moments away from the Fed's decision on interest rates. The federal funds rate has stood at a 23-year high of 5.25% to 5.5% since July 2023, as the Fed has been waiting for inflation to cool a bit more. Last month's Consumer Price Index reports show annual inflation has dipped to 3%, and that is far below the two-decade high of 9.1% back in June of 2022. But it's still too far above the Fed's 2% goal for them to be happy about it. Here to talk about all that we can expect and all the implications for you all, CBS News business analyst Jill Schlesinger and CBS News contributor Javier David are here in Studio 57. I mean, we think we always know what's going to happen heading into these Fed days. I'm going to start with you, Jill. What are you going to be paying attention to? Do you think that there's a possibility of a surprise?
Hey, there's always a possibility, but I don't think of this Federal Reserve Board and this sort of series of Fed regional presidents as people who are into surprises. They like to telegraph. Just a couple weeks ago, Chairman Powell testified before Congress, and he's like, we need some more good data. And then we had the San Francisco Fed president, Mary Daly, saying, like, yeah, we're not there yet. I don't think they go out and give those speeches to tee us up for a surprise.
Right.
I just don't see that happening.
Right. Javier, there were hints that interest rates could be cut in September. What factors might prompt that decision, and how much are we listening to the words today to try and see if September is going to equal a rate cut for us?
Right, and so just to sort of update us, the Fed, in fact, did hold as expected. The decision was just issued. We're going to wait and parse all the language. That's kind of like the fun part. But what they will likely be doing is they will be teeing us up for, a September cut, and we'll watch the dot plot, which is also, what Fed nerds like digging into. But as I mentioned, next month is the Jackson Hole speech. I do believe that, the Fed didn't want to preempt what is really widely considered like the big Super Bowl event of central banking. The Fed really takes pains to sort of telegraph its intentions to markets. There's a real sort of schedule that they like to follow, and Jackson Hole is a very big part of that. I think in order for them to have moved today, that really would have preempted what would have taken place next month at Jackson Hole. They don't want to do that. The Fed chairman's very deliberate. He's very precise. I don't think he likes to sort of, and it would have almost spooked markets, I think, if they had gone today.
Right. It would have been outside of the realm of likelihood.
I think it was a 4% probability.
Yeah,
at that point.
So we got what we expected. Rates are holding steady. But, Jill, some economists have said that that's not the right decision. In fact, we've seen other central banks already starting to cut their rates. So why is this Fed deciding to be so cautious?
I don't know. I mean, I think all the data kind of are in favor of a rate cut. They are methodical. I think they're incredibly spooked by seeing any sort of resurgence. I think that a year ago they thought they were on track to actually lower rates starting at the beginning of this year.
That's what we were thinking.
But then we saw inflation numbers kind of drift up. And, look, the last 3 months have really shown a lot of progress. I just think that they are erring on the side of we would rather be more cautious because the economy is not coming apart because of high interest rates. We just got a higher than expected read of economic growth in the second quarter. Consumers may be pulling back some. They're certainly not spending a lot of money at McDonald's, as we know. But,
or at Starbucks, as we know.
Starbucks. Right? But you know what? They're still spending. And so I think the Fed's just rather conservative in this way. They're also, not to sort of typecast them, but they tend to be somewhat older folks who are on this Federal Reserve Board who are so spooked by the shadow of inflation, the fact that they got it wrong at the beginning, that they just want to finish the job.
I know, but isn't part of the complaint that they waited too long?
Yeah,
right. So now,
and also it bears mentioning that these are like the heirs of Greenspan and Volcker and those guys.
We were filling in our audience. We were talking about Greenspan and Powell and how they're different.
Yeah, and they're very attentive to this idea that inflation is really difficult, and those guys were real inflation fighters, and they were really about emphasizing how difficult it is to corral inflation once it's been released from the bottle. I think Powell is of that school. I think they've learned the lesson from COVID, in which they sort of sat on rates for very long, and we use the word, remember, transitory. It's all going to go away at some point, and then until it didn't. So they're just really, really mindful of the fact that inflation could easily resurge.
And I'm just going to read a little bit from the press release from the Fed. They say that the recent indicators suggest economic activity has continued to expand at a solid pace. Job gains have moderated. The unemployment rate has moved up but remains low. Inflation has eased. All of these are good indicators that the U.S. economy is doing well. Jill, let's talk about the next indicator we're going to get, the Labor Department releasing its report. I believe that that's happening on Friday
morning. Yep.
What are we looking for in that?
So interesting in that statement, there are some clues. So get out your Fed decoder rings, because as soon as they say moderating, that's like, oh, okay, well, we're slowing down.
But it also feels like they're applauding themselves a little bit,
Oh, well,
too.
calm down about that.
Right.
We don't want to give them too much credit. It's like the arsonist fireman. We're like, well, we're happy you put out the fire, but we're sorry you said it. Look, I think that the jobs report's going to be interesting. We're expecting, let's just guesstimate, 175,000 jobs created. The unemployment rate stays at 4.1%. The wage gains are probably going to be 3.9, 3.8% higher than they were a year ago. All of this is what is expected. But a lot of the labor report numbers, when they first come out, seem better than expected. Then they get revised lower. We've had revisions in the last 4 of the last 5 months that have been lower. So the job market is slowing down. The Fed wants that. They love that, because that means wage growth will slow down. That means we will not spend as much and we will not contribute to inflation. So it's all somewhat circular. We'll see what the data show, but I don't see there's going to be some mystery. There could be something outsized that occurs in this report, but I don't know what the expectation is. There like a big upside surprise? I doubt that at this one, but we'll see.
Well, one last question for the both of you is that the economy, there's a disconnect between how people feel about it and all these positive indicators, and it is a major talking point for both campaigns. What is actually the state of our economy right now?
Well, it's a major talking point for corporate America. The results that we've gotten over the last several weeks has indicated that consumers are under pressure. There's a lot of chatter from the consumer side or the retail side, the banks, downturn of consumer discretionary demand. Consumers are getting really tired, and it's not just the lower income wage workers that we're talking about. We're talking about the upper income folks, the ones making 6 figures and above.
Which is a difference from some of the other times.
This is a marked difference from what we were seeing maybe just even several months ago, where it was a lot more striated and the higher income earners were still continuing to spend with abandon. But all of this is catching up. The high rates are catching up to consumers that are relying heavily on credit cards and are waiting to buy a house but can't because rates are at 6 or 7% and it's just not affordable.
Yeah, and interesting about that, though, I do think the real division in how people are feeling also has to do with whether you own a home and you own any investments. Because people who own homes and have some sort of retirement portfolio or some toe in the water of the investment world have just seen their net worth explode in the last 5 years.
The difference between borrowers and savers.
Absolutely.
Yeah, and I think that does kind of creep in. Everyone's going to pull back. You cannot sustain the amount of spending we were all doing over the initial opening of the economies after, COVID. But what is completely clear is that there is a virtuous cycle that could be afoot here. It could be that things are slowing down, not too much. The Fed starts to lower rates. That makes borrowing a little bit more affordable. People feel a little better. They spend a little more. So that is the hope of the Fed. That is the hope of the Fed. It's obviously would be a good thing for all of us if the economy continues to produce jobs. And I think the job market is the key.
All right. Jill Schlesinger, Javier David, thank you both.